Jim, let's start with that Goldman note that we referenced and that you were talking about with Becky a moment ago. Basically looking for solid gains into year-end, into the year after that, the year after that. But it collides with sort of the darkening picture that we're seeing on COVID in the U.S.
Well, look, I think that one of the things that David Kostin's doing, and David is an optimist, which, by the way, has certainly served him well during this period, is really identifying the principal weakness that we had. If you go back to Friday, there was a belief that the only companies that could really do well were the F.A.A.N.G and F.A.A.N.G derivatives, because we were not going to see any end to the pandemic. The idea that we got a vaccine, it really was a November surprise. A 90% efficacy vaccine was not in the cards. So I think that David's piece is very right, with the exception of the titles. I've already informed him I don't like the Roaring 20s redux because the Roaring 20s ended so badly. What I do like about it is that while the election is certainly important, what he's saying is we've got a rebounding in profits. We have a falling risk premium in equities, all of which I agree. Does suggest using a barbell, but I just think that he's dead right that you, with a COVID-19 virus, you can get away from just big tech. And I see a lot of industrials, David, where people are just frantically raising numbers. And that has to do with the fact that maybe in 2021, we will have this under control.
Well, we've gotten some optimistic commentary about it. I mean, Alex Azar yesterday, I believe Fauci also saying some things that indicate, perhaps to the point you were making earlier in the week, that it could be as soon as the spring that we really start to see wide vaccinations, which would be, of course, a great thing to think that if you were heading into the summer and you could get back to some normalcy then, because many people still believed it would be probably not until next fall.
Right.
Jim. So that's all a good thing. We continue to see this dichotomy in the market. Some of these stay-at-home plays losing some ground. As you point out, the industrials. We've also talked about the equal-weighted S&P and how that's outperformed of late. But again, I come back to this question. Do you really see growth being abandoned for the longer term here? Is value, as it's often been, just a very brief play that once again will be sold when, I don't know, when the market changes its mind, which it seems to do every time?
Yeah, growth doesn't go out of style because the growth companies are the ones that adapt very quickly. I mean, when you have a company, let's say you have Alphabet, okay? Alphabet, is it static? No. I mean, Alphabet's an advertising-derived site that needs travel advertising, which is the biggest and the best. Suddenly you get that. Does Facebook really get hurt here? No, because they're beginning to have a tremendous number of ads that are direct and very inexpensive to be able to promote businesses. I find these companies just keep coming up with new ideas. But, David.
Yeah. What?
Of all things, we have to watch Datadog.
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 Okay. Not Underdog. No. Datadog.
No, not Underdog.
I used to like that show.
Yeah, true. Well, you probably like Huckleberry Hound, too.
I did.
Datadog is a company that had revenue growth from 80% down to 68%, now 61% in this quarter. But, David, it sells at 40 times sales, okay?
Okay.
So now you have to watch that kind of stock because that's what's front and center of what's being sold. And, Carl, I think people are sick and tired of paying a huge amount on sales when they have the opportunity to pay a not great amount on earnings. So watch Datadog as being the tell of this tape.
Shepard Smith here. Thanks for watching CNBC on YouTube.